Now, welcome to the topic 3 workshop. Today we'll be doing some basic ratio analysis. Now, I'm guessing you would have done this in many other subjects, or at least one previously, so this content is not necessarily new. We're just doing it in the context of evaluation. Now, the workbook that you have on iLearn is called Homework Topic 3, and the structure is very similar to last week in the sense that we have a data sheet which provides us with all of our financial data, and again, we're using H&M as our example here. We then have the accounting analysis sheet from last week, and then we have the ratio analysis sheet for this week. And again, the structure is very similar. At the top, we have a bunch of inputs that we'll be using, and the only reason why I have the inputs at the top is so that when I calculate the ratios, I don't always have to go back to the data sheet. And again, I've pre-filled this for you more or less completely. The only thing that's missing is revenue. So to grab the revenue for 2011, you would essentially just press equal, go to the data sheet, and then grab the revenues from C9. Then what you can do is just drag that cell to the right to fill all the other years. So essentially what we have at the top is the inputs for our kind of ratio analysis, and at the bottom we have a few different ratios that we have to calculate. Again, for each ratio, you'll see that there are hints. So whenever you see the kind of red triangle at the top right-hand corner, you can see the hints which tell you exactly how you calculate that. Now, you do see that there's 6 years worth of information here, but for most of these ratios, we're only going to be calculating the last 5 years. And the reason for that is, for example, for return on assets, which is net income divided by total assets, is it that when we calculate a figure that has a balance sheet item, we usually average the last 2 years worth of balance sheet item. So in the sense that if you divide net income by total assets for 2012, you take net income for 2012 and divide it by the average total assets between 2011 and 2012. And the reason for that is really because the balance sheet is really just a snapshot at the end of the period, whereas the income statement item, net income in this case, is something that we would have kind of continuously received throughout the year. So we're just trying to make them match slightly better. Now you'll see that there are different sections, one for profitability ratios, one for activity ratios, liquidity ratios, and solvency ratios. And here at the bottom, it's basically just bringing it all together into DuPont analysis, which I guess, again, I'm thinking you would have covered in your probably introduction to accounting previously. Now at the bottom, you'll see there are a few homework questions. There's only 5 for this week, and essentially just have to answer in a short answer format. So again, don't write too much, but still perhaps write about, I would say, about 100 words on each question, just to give me an idea that you kind of understand the content here. So again, to calculate these things, it's going to go quite quickly, but all we're really doing, it's a bit mechanical in the sense of the exercise, but all we're doing is we're going through the hints. So for return on assets, we want to calculate our net income and divide it by our total assets. So in this case, we would equal to our net income, and again, you're going to go through this little input section and you find net income in cell D8. And then again, you're going to divide it by total assets, but again, you want to divide it by average total assets. So you can either take the 2 cells and divide them by 2, or you can use the average function in Excel. So type in average, open up a bracket, find your total assets, which are in row 14, highlight the 2 cells, close the bracket, and what that does is calculates the average, total assets for you. Similar for return on equity, again, go to the hint, it's net income divided by total equity. So again, we take net income from this year and we divide it by average total equity. So in this case, we're looking at the total equity, and again, we're going down, and it's not called total equity, it's called book value of equity, which is exactly the same thing. So take those 2 numbers and average them. Now for gross margin, we have 2 income statement items. So it's the gross profit divided by revenue. So in this case, because we are actually using 2 income statement items and we don't have to average the last 2 years, we can actually calculate it for 2011. So again, all we're doing is we're taking the gross profit and dividing it by revenue in 2011. So again, gross profit, cell C5, and divided by revenue in cell C3. Now the EBITDA margin is simply the EBITDA, so earnings before interest, tax, depreciation, and amortization divided by revenue. And again, it's two income statement items, so EBITDA and divided by revenue. Similarly, for the EBIT margin, all we're doing slightly differently here is we're taking the EBIT in this case, and again, dividing it by revenue in the same year. Net profit margin, similar in this case, but instead we're looking at the net income. So in this case, we're looking at equal to, going to net income in cell C8, and we're dividing it by revenue in cell C3. And that effectively provides us with all the calculations that we need. So what we need to do is effectively drag things to the right to have all the other years calculated for us. And again, drag it to the right, and you'll see that it should all kind of be done for you. And that kind of concludes the profitability section. And as you see, it's not necessarily too difficult this week. Now, for the activity ratios, we have 4 different activity ratios that we'll be calculating for this week. So for example, for asset turnover, you see that it's revenue divided by total assets. And with any of the activity ratios, we do use balance sheet items, so you always do have to kind of average the last 2 years. So we'll be only calculating from 2012 and onwards. So again, for asset turnover, you take a revenue and you divide it by the average total assets. So equal to revenue, and you divide it by, open up a bracket, average total assets. So there. And close the bracket, and it's 2.01. Now, on the other hand, fixed asset turnover looks at your revenue and compares it to your average property, plant, and equipment, or as you might have known it as PP&E in your other classes. So again, you take your revenue and you divide it by the average, open up a bracket, PP&E net, which is in cell C and D13. Close the bracket, and it's 6.62. We then have the accounts receivable turnover, which is your revenue divided by your accounts and notes receivable. So again, equal to your revenue in cell D3 in this case, and divided by average, open up a bracket, and in this case, accounts and notes receivable is in cell, let's see, row 11. So we take row 11, those two cells, close the bracket, and it's 53.17. Now the inventory turnover, it's something that we calculated last week, but last week we did not average the last 2 years worth of the balance sheet item, whereas in this week we will, so the number will be slightly different from last week. So we take the cost of revenue and divide it by the average inventories. So equal to our cost of revenue, and we divide it by average, open up a bracket, take our 2 inventories from the past 2 years, close the bracket, and you get 3.37. Again, once you've done that, you drag it to the right, and you've calculated all the activity ratios. For the liquidity ratios, we're only going to be calculating 2 of them, and they're effectively just measuring your short-term ability to meet your obligations. So for the liquidity ratio, we'll start with the current ratio, which is your total current assets divided by total current liabilities. So again, we have 2 balance sheet items, so we need to average both of them. So again, your total current assets divided by your total current liabilities. So we need to find our current assets, which is in row 9. Take the 2 years and divide them by the average total liabilities, or specifically total current liabilities, which is in row 15. And then you close the bracket, press enter, and you get 2.68. Now for the quick ratio, the formula gets slightly more complicated, because in this case we need to take 2 items from the balance sheet, add them up, and then divide them by another item on the balance sheet. But again, because everything is on the balance sheet, we still need to average each of these items. So in order to calculate this correctly, what you would take is, again, if you look here, it's cash and cash equivalents and STI plus your accounts and notes receivable divided by total current liabilities. So in this case, you put an equal sign, then you need to open up a bracket. You type in average, open up a bracket, cash and cash equivalents is in row 10. Close that bracket. Then you want to add another average, open up a bracket, and again, it's in this case, we're looking at the accounts and notes receivable, which is in the row 11. Again, close the bracket, divided by average, and again, sorry, I actually just made a mistake. You need two closing of the brackets, and then divided by average, open up a bracket, and in this case we take our current liabilities, which is in row 15. Close the bracket, press enter, and it's 1.49. Again, once you've done that, you just drag it to the right. Now, for the solvency ratios, we're primarily just looking at two simple ones, and that's total assets divided by total equity. And again, if you see here, the hint is exactly the same as what the text says, so you don't actually need the hints in this case. So again, we have two balance sheet items, so we need to average both the numerator and the denominator in this case. So we take an equal sign, and then we type in average, open up a bracket, take our total assets in row 14, close the bracket, divided by average, open up a bracket, and in this case we're looking at our total equity, which is the same as book value of equity. Again, close the bracket, and you get 137%. Now, total liabilities divided by total assets is again just as what it sounds like, and you open up a bracket, you type in average, open up a bracket, and in this case we're looking at our total liabilities, which is in row 16. Close the bracket, divided by average, open up a bracket, and in this case total assets, which is in row 14. Close the bracket, and you get 27%. So again, once you would have done those two, you just drag them to the right and you're more or less finished. So again, this concludes the Excel portion of the homework, in a sense the practical, and you then continue on with the theoretical bit. And again, why we're doing this as a homework is really that for your own project company, what you can do is you can grab the data using the Bloomberg data fetch file, and then you essentially get the data in exactly the same format as on this worksheet, so on the data worksheet. And what you can do is just effectively you can just paste over it, because once you paste it over with your own company's information, all these ratios would be calculated automatically for your company. So it kind of saves you time in the Thursday session. All right, so once you're done and you've answered all these questions below, just click save and upload it to iLearn.